Hi, this is Kim Schillig with Lepic-Kroeger Realtors, and today I'm sitting down with Pete Johnson from GreenState Credit Union, and we're going to talk about what's it going to take to get in the market this year. So, Pete, it's February, and we're getting ready to launch into our spring market. What are some of the things that buyers need to do and be prepared for if they want to buy in the next spring market?
Yeah. So for the first thing is kind of the pre-approval. So the pre-approval process is more about just kind of sitting down, taking a look at your overall financial situation, getting you educated about the process, and then trying to determine kind of what monthly payments are, what you think you can afford, and trying to narrow down a price range, things like that. So getting in with a good lender, I always kind of recommend a local, kind of a local lender that's local to the market. Tends to be a little bit better because we kind of know this market. We have a lot of relationships with the real estate people, the realtors, attorneys in town that are going to be kind of working on your transaction once you get it going. So getting that pre-approval is really important. I would set it some time, probably take some time to do it too. So a lot of people kind of rush through this process. Don't spend a lot of time kind of, going over the numbers, kind of figuring out what they can afford. Giving the loan officer some time to find any landmines that might be in the process that might cause trouble down the road. I always recommend kind of getting in. It doesn't take forever. It doesn't take a full day or anything, 30, 40 minutes, just sitting down with your loan officer, kind of going through that process, trying to get shake all the skeletons out of the closet, so to speak, to make sure that you kind of feel comfortable with what you're doing. You know how the process works. Getting prepared for that process, I'd say, schedule an appointment, like I said, in person or phone. It's usually very simple. There's nothing that's going to cost you any money or obligate you to anything in this initial appointment. You want to kind of bring your pay stubs. You usually want to have your 3 most recent paycheck stubs if you can. Your last 2 years W-2s, maybe your last 2 months bank statements if you don't already bank with the lender that you're talking to. And then, of course, if you're self-employed or maybe you have a side hustle, side gig of some sort, some other income that you want to bring into the equation, or you're retired, you probably want to have all pages of your federal tax return too when you set up the appointment. So.
Oh, very good. One thing you mentioned was a local lender, and knowing our market. That's I think that's an understated statement, really, particular for the Iowa City metro area. Would you mind diving in just a little bit on that and explaining maybe some of the differences between how local lenders look at investment in real estate versus the national lenders? Yeah.
There could be a big difference in the markets. Each market is unique. Each market has its own culture, kind of, so to speak. And so, a town like Iowa City, a medium-sized city like Iowa City, the Iowa City area, Coralville, North Liberty, Solon, even Tiffin, is a little bit smaller and costs are a little bit lower. Iowa's a pretty low cost closing cost state, for example. So when you're working with a lot of the local lenders, you're probably dealing with about the lowest rates you can get. There's not a lot of margin in what we do, regardless of whether you're working with a credit union or a bank. So you're generally getting the lowest closing costs. The lowest rates that you can get. And the biggest thing I would say is just the fact that we're here, we know the market. Like I said before, we kind of already know all the title people, all the people that are going to be involved in the transaction, getting you from point A to point B. So if there's a problem that comes up, we're going to probably be able to fix it a little bit easier, a little bit quicker. Just by way of the fact that we're just more familiar, right? And so when you're working with some of those bigger out-of-state lenders, especially some of the nationals, nothing wrong with the bigger nationals, but their overhead is typically higher, and their costs are usually geared in terms of what they charge for a loan. Their fees are usually geared towards bigger markets, some of the bigger metropolitan markets, and fees are always larger, I would say, on average. A little bit more expensive in some of those bigger markets. Not that they're trying to take advantage of anybody. It's just that's just how it is in those markets. And so when you're dealing with lenders out of state like that, it can be a little bit more expensive. Not always, but a little bit more expensive. I think the primary thing is the advantage of just having the local network here. We're just very familiar, very used to the market, and the odds of your deal going smoother, in my opinion, is a little bit higher when you're using a local, whether it be a bank, credit union, whoever it may be. So.
That's great information. I think a lot of people don't really understand those differences, particularly the closing costs, because people usually forget about that part.
Yeah. Yep.
Another thing relative to the home buying and the pre-approval process, does it affect their credit score, and what kinds of things about their credit score should they be aware of?
Yeah, that's a question we get a lot. So that's a big concern. I get a lot of people say, I don't really want to do a pre-approval yet because I don't want it to ding my credit, or I'm not ready to commit to a bank yet. So I think it's kind of important to know that when you're doing a pre-approval, you're not necessarily committing to a particular bank. You can still shop Although I would narrow, the banks that you allow to pull credit down to the ones that you think you're most likely going to go with. And typically that's 2 or 3 banks, doesn't need to be 15 or 20 banks. But there's a big myth around credit that pulling your credit negatively impacts your credit, or it'll drop your credit score, right? And that's a myth that we kind of have to dispel a lot. You're actually allowed to pull credit 6 times in a year. It's actually 6 times in a month before it counts as one of the 6 for the year. The credit bureaus, credit agencies, they know that you're shopping. They know that you want to shop for a mortgage, that you're going to pull your credit probably more than 1 or 2 times. And as long as you're not doing that, 36 times, like 40 times in a year, it's not really going to do anything to your credit. It is true that it will negatively impact your credit eventually. And when you see the reasons for why your credit score, if you see a credit report, there'll be reasons why your credit score was the way it was. And one of the lines that always freaks people out is it'll say, number of inquiries negatively impacted your credit score. And that's not true. But you would have to pull it an absurd amount of times, way more than the rational person's going to pull it. And I think this is what I usually tell people is that, the upside to getting a pre-approval done and being prepared and ready to go, especially in this market with as competitive as it is way more advantageous than the downside of potentially losing a few points, by pulling credit. And your credit inquiries is a really small part compared to like your payment history, your credit card balances, how much money you owe on the credit cards versus what your available limit is. Those things affect your credit score way more than pulling credit will ever do. So as long as you're not getting crazy with it and you're allowing the banks that you think you're most likely to go to pull credit, I think you're going to be fine there. It's not a reason to not do the pre-approval.
So sometimes clients will say, I've been checking my credit online and I'm good to go. So I don't need that pre-approval. We'll just take care of it right when we get ready. And I'm not a lender, but are all credit checking services the same?
Yeah, definitely. That's another thing that we get a lot. I say there's 2 things there. The advantage to getting and doing the pre-approval, it's not just so much like a credit check and then quote me a rate and quote me some fees. It's really more about educating you about the process because there's more to it. This is a pretty big purchase, right? You're not just buying a TV over at Costco or something like that. You're buying a home that you might be living in anywhere from 5 to 10 or maybe longer, right? And it's probably the biggest purchase that you're going to make, or one of the biggest purchases you're going to make in your life. And so taking a little bit of time to get educated, go through that pre-approval process is a big reason to do it. It's not just getting quoted rate, closing costs, and then, give me that pre-approval letter and send me out the door. In regards to the credits, you're 100% credit reporting agencies. You're 100% correct there. The only ones that really matter are TransUnion, Experian, and Equifax. Those are the ones that any bank, most banks, and credit unions are going to use to determine whether you qualify for a mortgage or even like a car loan or a credit card most of the time. So the stuff that you see on your credit card statements and on your bank statements, they try to mimic what Equifax and TransUnion and Equifax do, but and sometimes they're great at it. Sometimes those scores are pretty close and sometimes they are way off. So I've seen them be as much as 50 to 100 points off what your actual credit score is. And I think that frustrates a lot of people because they see, hey, my credit card statement said I had an 800 score. And then when we pull it when we're getting you pre-approved for a mortgage and it's 740 and people are really disappointed and they can't figure out why. And then of course, the next statement we get is like, well, it was because you pulled my credit. My scores dropped because you pulled my credit. And it's not that, it's just that the scoring models are different. The one that you're using online is trying to mimic what Equifax and TransUnion Experian are doing, but they're not getting close. So if you really want to know what your credit score is, pulling from those bureaus would get you a heads up. But to be honest with you, it's easier just to come in. We're going to need to pull that credit anyway. That way you're only paying for it maybe once. Let's just get the credit report that we're actually going to use to make the decision so we could get it figured out accurately the first time. So
when someone gets their credit score and when they are meeting with their lender and they're figuring out their closing costs, does a credit score matter to the interest rate that you are quoted? Yeah,
definitely it can. And that's gotten really confusing in the last few years. So it used to be if you had, like a 7, so for a while it was 720 and then it kind of moved to a 740 credit score was the magic number. It's up to, I think, about a 780, in some cases 800 is kind of the magic number now. And that can make a big difference in terms of the interest rate you get. It's going to make, a full percentage point difference, but it could, especially once you get into the lower credit score ranges, you drop down into like the mid to low 6s, unless we're using something like a first-time homebuyer program where you don't get dinged as much for that stuff. it could make a pretty big difference in your interest rate. And again, that's another reason to kind of get pre-approved, so we can kind of figure out what those landmines are. Maybe there's something on your credit that we can help you get corrected that shouldn't be there. Maybe we can up that score. So getting in there and kind of figuring that out ahead of time is key for that reason too. So
great. Now, what are your top three things that a buyer can do to get ready if they want to buy in the next 6 months?
Right. I have about 50. I'll give you 3 plus a bonus. But the biggest thing is be prepared. We talked about that, not waiting on the pre-approval. I hear a lot of people say, hey, I'm not planning to buy, for a couple months, or they'll say, I may not buy till next year, and that's fine. I can't even count the number of times where I've had somebody say, I'm not buying maybe till next year. And then literally a week later, I get a phone call with a purchase agreement and they're ready to go now. The perfect house popped up. So being prepared, even if you're not buying this year, that pre-approval process will flush out any problems, any landmines, any humps that we need to overcome to get you there. Make sure that we know that you're qualified. So being prepared, especially as competitive as things are, is super important. The other thing is not changing anything. Okay. So not making any change or adding anything new car loans, new credit cards, those kinds of things can disqualify you or, in a best case scenario, maybe reduce what you're qualified for. We're usually looking at monthly payments there. So you may only add like a $5,000 balance on a credit card, but if the monthly payment is $250 a month, that's going to reduce your ability to buy a home by $50,000. That's $50,000 less home you're going to be able to buy for that reason. So boat loans, car loans, toys, stuff like that. If you can avoid doing new stuff, that's always good. Keeping your employment stable too. So really important to not make major changes to your job. Dropping your hours, moving from say full-time to part-time. Could dramatically increase whether you're qualified or not. Going from being a regular W-2, what we call kind of a salary employee, where you're working for a company, to starting your own business or becoming self-employed. That's going to be a big deal. If you're thinking about doing that, it's always a good idea to call your loan officer, because once you make that change, we've got to have a 2-year history of your income. So that could delay you by 2 years, especially if you've done it after you've already gotten the initial pre-approval when you're an employee. And now you're making that change and you didn't tell your loan officer. Those are never good surprises for us. And
those don't close generally, right?
Yeah. Basically, yeah. Always check in, check in to make sure that, what the decision you're making, and odds are you can take that new job, especially if it's higher income. You can take that new job. Just check in with the loan officer. Just make sure that the timing of the job, when you start, the pay that you're going to be receiving, how you're being paid, is going to work for the loan that you were pre-qualified for. And then finally, large deposits, moving money around. Okay, so try to avoid, bringing huge lump sums of cash over from one account to another, moving money around. We're a university town here, University of Iowa, and so we get a lot of foreign buyers coming into town, taking jobs at the U, and then they're bringing money with them from overseas, and that can be really hard. So a lot of people think, well, it's my money. What difference does it make? I'm just going to deposit it in my account. The reason it makes a difference, because there's a lot of anti-money laundering rules that we have to follow as mortgage originators, verify that money isn't coming from a source that's not supposed to come from, some illegal source. So every time you move money like that, big chunks of money around, it causes a lot of extra documentation. And in some cases, it can get to the point where we can't even use the funds because we aren't able to document them. Cash is a big thing. If you got a gift from grandma for $3,000 in cash, you're thinking, why not? I'll just deposit it in my account. That's a problem. It's really hard to verify. So just making sure you document that, and better yet, maybe just calling your loan officer before you make those moves makes it a little bit easier to document down the road.
Great. And when those folks that are moving the money around or bringing large deposits, how long does that money need to be settled where it is here?
Yeah, typically the standard, and it's sometimes different depending on the type of loan that you're doing, but 60 days. We call it seasoning. Once the money's been sitting in your account for 60 days, it's typically considered to be your funds. So where the problems arise is when we're trying to shuffle money around from gifts. This comes up a lot with gift funds, where mom, dad, grandma, whoever it's going to be, is gifting $20,000, $30,000, $40,000, and they just write a check and deposit it. That can be difficult. We've got a process for that. We have gift letters for that to verify where that money's coming from. But if your parents want to throw your gift money into your account and you're not buying for 2 years, you might be fine as long as it's been sitting in there for at least 60 days or greater. So
great. Thank you so much.
You bet.
Hopefully we'll be able to do lots of business together this year.
I hope so. I think it'll be good.
Awesome.
All right.
Thanks,
Thanks Kim.